Welcome everyone to the deep dive. Today we are plunging into a truly fascinating, complex, and frankly, pretty tangled global economic tug of war. We're talking about the significant impact of tariffs and their ripple effects, and how these new realities are colliding head on with the Federal Reserve's, well, steadfast approach to monetary policy. It's a dynamic interplay that affects everything, really, from international trade flows right down to your daily finances.
That's absolutely right. For you, our curious listener, our mission today is to unpack a truly monumental economic shift. President Trump has effectively carved out a new global 15% tariff floor for trade. We'll explore how this is fundamentally altering trade relationships and, crucially, how it interacts with the Federal Reserve's remarkably stubborn stance on interest rates. We've compiled a comprehensive stack of recent articles and updates to guide us, some critical insights in there. Our goal is to equip you with the knowledge to understand what this means for markets, for businesses, and most importantly, for your wallet.
Yeah, you've likely heard the buzz. President Trump has effectively established this new global baseline for tariffs. And this isn't just like a minor adjustment, it's a strategic reorientation of trade policy, effectively setting a new 15% minimum duty on imported goods. But here's the twist. Despite this huge shift, the Federal Reserve still appears determined to hold steady on interest rates. It makes you wonder, what exactly is happening behind the scenes, and what are the deeper implications of this, unique economic intersection? Let's unpack this.
What's truly fascinating here, I think, is that this new tariff baseline marks a significant reordering of global trade dynamics. We're moving beyond, well, targeted duties on specific goods or countries, which were always a major disruptive force, right? Now it's a broader, more universal application of these tariffs. This systemic change will inevitably ripple through global supply chains, fundamentally reshaping production decisions, procurement strategies, and ultimately influencing inflation. And this creates a complex and quite challenging environment for central bankers who, as we know, prioritize stability above almost everything else in their monetary policy decisions.
Stability, yes, a word that feels more aspirational than actual these days. And just to put a fine point on the scale of this shift, our source material explicitly states that tariffs would range from 15% to 50%, with tougher partners facing higher rates. And that's a big step up from the 10% baseline duties currently in effect. So, we're not just talking about a minor adjustment. This is truly a whole new ballgame, signaling a significant escalation in global trade policy. Okay, let's dive into our first segment. The Trade Quick Rundown, New Deals, New Realities. This 15% tariff floor. It isn't just a number, is it? It represents a fundamental shift in trade philosophy, moving away from more nuanced product-specific duties towards a broad, almost universal application. For years, the global economic discourse has debated free trade versus protectionism, but President Trump's long-standing campaign promise of creating a ring around the collar with tariffs, maybe 10–20%, well, now appears to be fully realized. This is quite the turnaround, especially considering that even in recent weeks, there were discussions suggesting perhaps a more lenient 10% baseline for smaller countries. This clearly signals a more hardened stance.
The establishment of this 15% baseline tariff, yeah, it definitely signifies a hardening of trade policy, unequivocally signaling a long-term shift towards protectionism. This uniform floor, while, seemingly simplifying a previously complex and often unpredictable tariff landscape, fundamentally embeds higher import costs into global commerce. This means businesses worldwide must now fundamentally alter their trade relationships and, importantly, reevaluate their entire global supply chain strategies. It's no longer about navigating exceptions. It's about operating under a new, higher baseline cost for international trade.
That's a huge point. The shift is palpable, and it materialized quite quickly. Our sources note that this 15% baseline is a shift. Even from just recent weeks, Trump earlier this month said many countries might see a rate of probably 10% or 15%. We haven't decided yet. And even last Sunday, Commerce Secretary Howard Lutnick was saying, assume small countries will have a baseline tariff of 10%. So the 15% wasn't a foregone conclusion. It solidified very recently, indicating a rapid consolidation of policy.
It truly is a remarkable consolidation. This signifies a more aggressive and broadly applied approach than may be initially projected. The previous flexibility that might have been extended to smaller economies appears to have been, well, largely abandoned, replaced by a more universal application of higher duties. This means that a broader swath of global trade will now operate under a higher cost structure, impacting everything from components and advanced manufacturing to the consumer goods we buy daily. It's a clear signal that the era of seemingly unfettered free trade, which many had become accustomed to, is now firmly in the rearview mirror. For global businesses, this isn't just a hurdle, it's a remapping of the entire competitive landscape.
Indeed. And speaking of big shifts, let's talk about the U.S.-EU agreement signed on Sunday, July 28, 2025. This deal established a baseline tariff rate of 15% on EU goods imported into the U.S. For the EU, this was truly perceived as a least worst outcome, wasn't it? They accepted the 15% to dodge a far more punishing threatened 30% reciprocal tariff. When you consider the potential damage a 30% tariff would inflict on their export-driven economies, yeah, 15% was certainly the lesser of two evils.
Absolutely. The EU's acceptance of the 15% tariff serves as a significant reality check for the bloc, potentially undermining some of its claims of being, a leading global economic force. Reuters reported this deal was perceived as a cold shower for the EU, effectively pushing them into a least worst scenario. After failing, maybe, to bring sufficient leverage to the trade table, an unnamed EU diplomat candidly admitted we were dealt a bad hand. This deal's the best possible play under the circumstances. This starkly illustrates a strategic shift in global power dynamics where the U.S. appears to be dictating terms with increasing assertiveness.
It certainly paints a vivid picture of the negotiations, and despite this cold shower, there were some interesting and varied reactions within the EU. Italy's Prime Minister Giorgia Meloni, for instance, called the agreement positive and sustainable, particularly if that 15% wasn't added to previous duties. Considering Italy's substantial trade surplus with the U.S., over 40 billion euros in 2024, this deal provided a much-needed degree of relief and predictability, for a significant portion of their export market anyway.
Yes, her reaction highlights the pragmatic approach some member states are taking. For a nation like Italy, the certainty of a 15% tariff, even if higher than desired, is undeniably better than crippling uncertainty and the looming threat of a 30% tariff. It stabilizes a significant portion of their export market, allowing businesses to plan with, greater confidence. However, it's crucial for you, our listeners, to understand that many details remain unresolved, indicating that this agreement is more of a framework for ongoing negotiations than a final, comprehensive settlement.
Absolutely. Some crucial elements are still pending. For example, there's a lingering disagreement on pharmaceuticals. Trump implied higher tariffs, while von der Leyen stated the agreed 15%. And a significant point for many consumers and industries, wine and spirits. There's no definitive decision there yet. The Distilled Spirits Council is actively lobbying for zero tariffs, meaning no tariffs at all for these categories. But on a positive note, a zero tariff rate was definitively agreed upon for specific strategic products, aircraft and parts, certain chemicals, and some generic drugs. That's a clear win for those industries.
The unresolved details, particularly for sensitive sectors like pharmaceuticals and alcoholic beverages, they underscore the ongoing complexities and the somewhat fragmented nature of these trade negotiations. While strategic products like aircraft components secured favorable terms, the lack of clarity on others leaves key industries in a state of considerable flux. This piecemeal approach to agreements means businesses in these uncertain sectors still face significant planning hurdles, which can delay investment and impact supply chain decisions. It highlights that even with a broad agreement, the devil is often in the specific sectoral details.
Now let's pivot to the east and discuss the China-U.S. truce extension. Is it a pause, or does it signal true peace in the ongoing trade disputes? Reports indicate a tariff truce extension by another 3 months. The expected outcome of the Stockholm talks is that no additional tariffs will be imposed, and there will be no escalation of the trade war by other means. For the moment, this brings a welcome period of relative calm.
This extension, in many ways, it's a strategic maneuver by both sides. While it undeniably provides a temporary de-escalation of immediate tariff threats, it's vital to understand that it doesn't resolve the underlying structural issues in the trade relationship, the ones that have fueled the tensions. It simply creates a window for further negotiation rather than a declaration of peace. Sources report that during these talks, China specifically intends to press on fentanyl-related tariffs, indicating their own strategic priorities beyond just traditional trade goods. This suggests that while direct trade tariffs might be on hold, other contentious issues, particularly those touching on national security and public health, remain very much present and active.
That's a very important point. It feels like an opportunity for both sides to, catch their breath before the next round of discussions. And then we have Japan's intriguing sweetener deal, which also ties into the critical TSMC angle. On the surface, it was announced as a massive $550 billion investment deal with Japan, accompanied by a 15% tariff on Japanese goods. But as we dig deeper, this story proves to be a bit more complicated, doesn't it?
It absolutely does. What's truly fascinating here is the immediate discrepancy that emerged. Japanese negotiator Ryosei Akazawa quickly clarified that only 1–2%, or roughly $5.5 billion to $11 billion, of that widely reported $550 billion figure is actual direct investment. The vast majority consists of loans and guarantees. This dramatically changes the nature of the deal from an outright investment of Japanese capital to a financing framework where the U.S. essentially facilitates the use of Japanese credit and guarantees.
So it's not as simple as Japan just handing over a massive check. It's a more intricate financial arrangement. But giving that clarification, what was Japan's perceived gain from entering into such a complex agreement?
Japan's gain, as Akazawa detailed, is quite significant for their export-oriented economy. Tokyo anticipates saving roughly $68 billion through lower tariff rates, going from previous threatened rates of 24% or higher down to the new 15% baseline. So while the investment narrative from the U.S. side was, let's say, grandiose, Japan's primary objective was clearly to mitigate its tariff exposure and gain preferential treatment compared to other nations. It was a strategic trade-off.
That certainly clarifies their motivation. And the profit split from this investment fund is also quite telling. The U.S. is set to receive a commanding 90% of the profits, with Japan receiving just 10%. Japan had originally proposed a 50-50 split. President Trump even publicly referred to this as a signing bonus, which really highlights the imbalance in the negotiation leverage.
This skewed profit distribution further underscores the asymmetric nature of the agreement. Japan is essentially buying down its tariff rate and securing a more favorable trade environment. While it benefits Japan by reducing significant trade friction and potential export losses, the terms heavily favor the U.S., framing it almost as a transactional payment for tariff relief rather than a truly reciprocal investment partnership. It's a textbook example of using the stick and carrot approach in trade negotiations, where the tariff acts as a compelling stick.
And the interesting connection here is to TSMC, Taiwan's semiconductor manufacturing company. The Japanese funds, as suggested by Akazawa, could potentially help finance Taiwanese chip makers building plants in the U.S. This would strategically leverage TSMC's existing $100 billion investment and 3 planned fabrication plants in Arizona, a critical move for domestic semiconductor supply.
Connecting the Japanese funds to TSMC is, well, a masterstroke in strategic economic policy, directly addressing critical supply chain vulnerabilities in semiconductor manufacturing, especially given geopolitical tensions. It allows the U.S. to indirectly leverage foreign capital to bolster domestic chip production, which has become a paramount economic and national security concern. However, it's worth noting that the Financial Times reported cracks have appeared regarding conflicting accounts of the deal's precise structure and profit distribution, underscoring a persistent lack of clarity and the potential for future disputes or misunderstandings. This lack of transparency, if unresolved, could undermine long-term trust and the smooth implementation of these complex agreements.
Okay, let's talk about the real-world ripple effects. Who's feeling the squeeze, who's breathing a sigh of relief, and what are the unaccepted outcomes of these new tariff realities? This brings us to our second segment. Winners, losers, and the weird ones, sector by sector. It's where abstract policy meets the bottom line for major global companies.
This is a particularly insightful part of our discussion,
Yeah.
as it's where policy directly impacts market valuations and corporate strategy. We can observe the immediate reactions and, longer-term adjustments in various sectors.
Exactly. Let's start with ASML, a name that's been making significant headlines in the tech and trade world. Their shares were up nearly 5% in pre-market trading after a hint of zero tariffs on chip equipment was floated as part of the US-EU agreement. This is fantastic news for them.
ASML's positive market reaction highlights the immediate relief and the powerful catalyst that clearer trade policy can bring to capital-intensive sectors, like semiconductor equipment manufacturing. JP Morgan's analysis confirms this. ASML had previously indicated significant hesitation from customers to place orders for new U.S. fabs due to the very real risk of tariffs applying to their specialized tools. This potential agreement could significantly de-risk future investments and orders for critical chip manufacturing equipment, providing a much-needed boost to ASML and other European semiconductor equipment companies like ASM International. It's not just about one company. It's a powerful illustration that in a world of high trade uncertainty, clarity itself becomes a form of competitive advantage. For capital-intensive sectors, the removal of tariff fog can unlock significant, previously delayed investments, signaling a potential bullish catalyst for similar industries.
Right, but there's a catch, isn't there?
Well, yeah. It's crucial for you, our listener, to be mindful that ASML just a week ago issued weak guidance for its own operational performance, which significantly hammered the stock prior to this tariff news. So while the tariff news is a positive catalyst reducing trade uncertainty, investors need to balance this against the company's own recent cautious outlook on its operational performance. The long-term impact will depend on how quickly this tariff clarity translates into actual new orders and production ramps, offsetting any internal operational challenges.
That hesitation was a considerable obstacle for ASML, so this newfound clarity is truly paramount for their forward momentum. Now, turning to another tech giant, NVDA, there's an interesting twist involving export controls. The Financial Times reports that President Trump effectively froze restrictions on technology exports to China. This move was explicitly made to avoid hurting ongoing trade talks with Beijing and to help secure a crucial meeting between Trump and President Xi Jinping.
This decision on NVIDIA demonstrates a sophisticated yet precarious strategic balancing act between pressing national security concerns and immediate trade negotiation priorities. The specific case of NVIDIA's H20 chip export ban being averted, especially after direct lobbying from CEO Jensen Huang, is particularly telling. This chip was engineered specifically for the Chinese market, designed as a less powerful alternative following earlier Biden administration restrictions on more advanced chips. The internal battle between security officials, who argue the H20 could still aid the Chinese military's AI development, and NVIDIA, which counters that blocking U.S. tech only forces China to accelerate its own domestic innovation. Well, it highlights the incredibly complex and often contradictory considerations at play here. It's a classic dilemma between containing technological advancement and maintaining market access.
It sounds like a very tricky tightrope walk. Moving on, Heineken and the broader big alcohol sector are definitely feeling the pressure from the 15% tariffs. Heineken, for its part, welcomed the certainty of a 15% tariff versus the earlier threatened 30%, but they are still actively weighing long-term options, including potentially shifting some manufacturing operations. Such strategic shifts are incredibly capital-intensive and absolutely require consistent, predictable policy to be viable in the long run.
For global conglomerates like Heineken, the certainty of a 15% tariff, even if higher than preferred, is indeed preferable to the sort of Damocles represented by a 30% threat. However, the very need to consider shifting manufacturing underlines the profound and disruptive impact these tariffs are having on established global supply chains. The big alcohol players, including Pernod Ricard, Diageo, Campari, and Remy Cointreau, saw initial stock rises upon the deal's announcement, only to see them decline as the full implications settled in. Alcohol exports to the U.S. were a significant $10.5 billion in 2024. Cognac makers, who had just managed to avert 35% duties from China, now face a fresh and substantial challenge from these U.S. tariffs. And notably for wine and spirits specifically, a definitive U.S.-EU agreement on tariffs is still pending, keeping these key industries in a prolonged state of suspense and uncertainty.
So it's certainly not smooth sailing for them yet. Now, on the automotive side, Audi, a major German car manufacturer, recently cut its full-year guidance, directly citing higher U.S. import tariffs and significant restructuring expenses. This follows a similar guidance cut from its parent company, Volkswagen. Audi now expects revenue between $65 billion and $70 billion, a downward revision from their previous range, and anticipates an operating margin of 5–7%. This is a direct and quantifiable impact on their financial outlook.
The guidance cuts from Audi and Volkswagen are a clear, undeniable illustration of how tariffs directly impact multinational manufacturing giants. Higher import costs for vehicles and, crucially, for the complex network of components that go into them, directly erode profitability. This forces companies to revise their financial outlooks downwards and, more importantly, can trigger significant restructuring. This ripple effect extends far beyond immediate sales, potentially impacting long-term investment decisions, R&D spending, and even employment levels within the sector. It serves as a significant indicator of the tangible financial strain these trade policies impose on complex global industries.
And finally, let's look at LG Electronics. In an interesting turn, consumers actually rushed to purchase appliances in the first half of 2025 to avoid the impending tariffs, leading to a 3% growth year-over-year in sales. People were clearly thinking ahead, trying to beat the price hikes. But despite this surge in demand, LG's net profit surprisingly fell 3.1% in the second quarter due to increased operating costs. The company is now actively considering adjusting prices and potentially moving production to Mexico and the U.S. if the tariffs, which stand at 25% for South Korea, 20% for Vietnam, and roughly 50% for China, take full effect.
This case really reveals a double-edged sword for manufacturers. While pull-forward demand can temporarily boost sales figures, as it did for LG, it's an unsustainable trend and often comes at the cost of higher operating expenses or reduced margins, ultimately impacting overall profitability. LG's active consideration of shifting production to Mexico and the U.S. is a classic tariff mitigation strategy. It indicates that these protectionist policies are not just causing price adjustments, but are prompting significant, potentially permanent reconfigurations of global manufacturing footprints. Companies are compelled to optimize their cost structures by relocating production to avoid prohibitive import duties, effectively reshaping the future of global supply chains. This shift towards regional or domestic production is a new and significant direction for many industries.
Okay, let's move forward now. This isn't just about trade policy. It's also about a fascinating and intense showdown between political will and established monetary policy. The White House, quite clearly, wants lower interest rates, but the Federal Reserve seems determined to hold its ground. So what's really happening here, and what are the deeper implications of this friction? Welcome to segment 3. The Fed-up segment: pressure, politics, and policy.
This segment brings us directly to the core tension point in the current economic landscape. The central bank's independence is continuously being tested, particularly when political objectives directly clash with economic realities and the Fed's dual mandate of price stability and maximum employment. This particular dynamic is a classic high-stakes example of that inherent friction.
And the pressure is coming directly from the highest office. President Trump has been engaged in an ongoing campaign of undermining Fed Chair Jerome Powell's credibility for months. Listeners might recall that highly unusual visit to the Fed headquarters where Trump directly confronted Powell in person, publicly challenging him over the cost of a $2.5 billion renovation project. Trump claimed it was $3.1 billion, and Powell corrected him right there in front of reporters. That was a very public, very direct confrontation, laying bare the tension between them.
The escalating political pressure on the Federal Reserve to cut rates is a recurring theme in modern economic history, but the sheer directness and public nature of Trump's interventions are highly unusual, and indeed challenge the traditional separation of powers designed to ensure the Fed's independence. The central bank is unequivocally focused on its dual mandate of price stability and maximum employment. In this environment, it views current tariff-induced inflationary pressures as a primary concern, which, from their perspective, requires a cautious wait-and-see stance on interest rates. The risk for the Fed is that caving to political pressure could compromise their credibility and make it harder to manage inflation expectations in the long run.
Indeed, Trump's demand has been consistently clear. Interest rates have to come down. And more recently, he's even played down overt firing threats, remarking that Powell's term ends pretty soon anyway, in May. This is a very public, very direct form of political pressure on an ostensibly independent institution. As our sources highlight, White House officials have been hammering Powell for months over his wait-and-see rate stance and his insistence that more time is needed to assess how tariffs will affect inflation. This isn't just a casual remark, it's a sustained, coordinated campaign.
This constant public hammering by the White House creates an incredibly difficult operating environment for the Federal Reserve. It forces them to not only make tough economic decisions based on data, but also to vociferously defend their institutional independence against external interference. Their focus remains steadfastly on the economic data, particularly how the recently implemented tariffs might influence the path of inflation. While there are undoubtedly intense internal debates within the Fed, with some officials potentially more sensitive to political rhetoric, the prevailing view among many remains firmly anchored to their data-driven mandate. Former Kansas City Fed President Esther George went so far as to call the White House's actions a campaign of undermining the chairman's credibility, underscoring the gravity with which the Fed views these external pressures and the potential long-term damage to its authority.
So it's not just about what the economic numbers say, but also about protecting the integrity and independence of a crucial financial institution. That's a very significant aspect of this dynamic. Now, for all you out there wondering, so what does this all mean for my investments? This new tariff reality isn't just about abstract trade policy. It's about fundamentally reshaping market dynamics. Let's talk about where to look for potential opportunities and where to find defensive positions that offer resilience. This is segment 4, the portfolio playbook navigating the tariff landscape.
This is truly the most important question for our listeners today. Understanding the investment implications of these sweeping trade shifts is absolutely crucial for any learner. It's about adapting your investment strategy to a rapidly changing global economic environment, moving from a paradigm of globalization to one of increasing localization and protectionism.
It's exactly. First, let's talk about the inflationary pressures and how they relate to rate sensitivity. The market is increasingly beginning to price in a stickier CPI as a direct consequence of these tariffs. To put it simply, when tariffs are imposed, they directly increase the cost of imported goods for businesses. These businesses often pass those increased costs onto consumers, which then directly pushes up the consumer price index, a key measure of inflation. It's a very direct inflationary channel.
Tariffs inherently introduce an inflationary impulse by raising the cost of imported goods, which undeniably complicates the Federal Reserve's primary efforts to manage inflation and maintain price stability. Investors should absolutely recognize this sticky CPI risk. The Yale Budget Lab, for instance, estimates that the Trump administration has already hiked the average tax on imports from a modest 2.5% to approximately 20%. This significant increase has the potential to raise about $290 billion per year in new revenue for the federal government. But it's critical to understand that this revenue is effectively a broad-based tax hike on American businesses and ultimately on American consumers, as higher import costs translate into higher domestic prices. This creates a challenging environment where the cost of living could rise, even as economic growth might face headwinds from trade friction.
So, what does this stickier CPI mean for investors, specifically for their portfolios? It implies that sustained higher interest rates, which the Fed might need to maintain to combat this tariff-induced inflation, could disproportionately affect companies reliant on discretionary spending or those with high growth valuations. These rate-sensitive growth names, often found in the technology or consumer discretionary sectors, could face significant headwinds as their future earnings are discounted more heavily in a higher interest rate environment. Investors might need to recalibrate their expectations for sectors that have historically thrived on the twin benefits of low-cost imports and easy credit. Conversely, sectors less reliant on global supply chains or with strong pricing power could become more attractive. That's a crucial insight for portfolio positioning. Now, let's look at the trade beneficiary basket. Who stands to win in this new scenario? We already touched on ASML. These semiconductor equipment companies are clear examples of potential beneficiaries from reduced tariff uncertainty and the broader strategic shift towards onshoring critical chip manufacturing investments in the U.S. This makes them particularly attractive plays right now.
Indeed. The clarity around chip equipment tariffs removes a major cloud of uncertainty that was directly impacting customer orders, as ASML itself noted. Beyond that, another interesting category of beneficiaries could be U.S. rail and port REITs, that's real estate investment trusts, focused on rail and port infrastructure. While tariffs can disrupt traditional global trade flows, they also create an incentive for domestic production and the more efficient internal movement of goods. Brian Jacobson described this as a stick and carrot approach. Tariffs are the stick, making it more expensive to produce outside the U.S., while incentives act as carrots to make it cheaper to produce inside the U.S. This fundamental shift towards domestic supply chains could mean increased activity and higher demand for internal logistics infrastructure, benefiting these specialized REITs.
That makes a lot of sense. If goods are increasingly made domestically, they still need to be transported efficiently within the country. So what about defensive moats? Which sectors or types of companies offer resilience in this new tariff inflation regime?
In a sustained tariff inflation regime, safe harbor sectors would generally be those with strong domestic production capabilities, a low reliance on imported inputs, or significant pricing power that allows them to pass on increased costs to consumers without losing substantial market share. Think about companies that produce essential goods or services locally, where their supply chain isn't heavily exposed to international trade disruptions and duties. Spirits companies, particularly those actively considering or already pursuing U.S. manufacturing pivots, could effectively mitigate tariff impacts. While they initially face tariffs, those with existing or planned U.S. production capabilities can gain a significant competitive edge by reducing their exposure to import duties. Heineken, for instance, is already weighing options for shifting manufacturing, although they rightly point out that such moves are incredibly capital-intensive and require long-term policy consistency to justify the investment.
And what about those everyday items, consumer staples?
Consumer staples with existing or planned U.S. manufacturing pivots also offer a strong defensive moat. Consumer staples, by their very nature, are generally more resilient during periods of economic uncertainty because consumer demand for essential goods remains relatively stable regardless of the economic climate. If these companies can effectively onshore their production to avoid import duties, they can maintain their pricing power and protect their margins, shielding themselves from international trade shocks. LG Electronics' active consideration of moving production to its existing plants in Mexico and the U.S., especially for products like large appliances that have seen past tariff impacts, exemplifies this strategic move. This represents a direct, actionable solution for companies seeking to insulate themselves from these new trade realities.
We always love hearing from you, our insightful listeners. You've sent in some fantastic questions, and we're ready to tackle them head on. This is segment 5. Lightning Q&A, your questions, our insights.
As always, your questions help us deep dive even further into these complex topics and bring them to life. Let's get to them.
Okay, first question. How could 15% tariffs flow through the Consumer Price Index, or CPI, versus the Personal Consumption Expenditures, or PCE, price index?
Okay, good question. So a 15% tariff imposed on a broad range of imported goods will likely have a more direct and immediate impact on the Consumer Price Index, or CPI. The CPI measures a fixed basket of consumer goods and services, and it directly captures changes in the prices of imported items like cars, electronics, apparel, and many household goods. So you would likely see the cost of these imported items reflected almost immediately in higher prices within the CPI basket. For example, if a significant portion of the cars sold in the U.S. are imported, a 15% tariff on them would quite quickly push up the CPI's transportation component.
Right, that makes sense. And the PCE?
Well, it's flow through the Personal Consumption Expenditures, or PCE, price index, which is the Federal Reserve preferred inflation gauge, might be slightly more nuanced and potentially slower. The PCE includes a broader range of goods and services, including nonprofit services, and its components are weighted differently compared to the CPI. Crucially, the PCE also accounts for changes in consumer behavior, meaning if a tariffed imported good becomes too expensive, consumers might substitute it for a cheaper domestically produced alternative. So, while both will feel the inflationary push, CPI might show a sharper initial rise in specific import categories, while PCE might reflect the broader, albeit slightly smoother, absorption of these costs across the economy, as consumers adjust their buying habits and producers reevaluate their sourcing. The Fed watches PCE for those underlying inflation trends that are less susceptible to short-term price volatility.
That's a very clear and helpful distinction, highlighting the subtle but important differences the Fed considers. Second question, what's the probability of a Fed cut in Q4 2025 if these 15% tariffs stick?
Probability. Well, if these 15% tariffs become a sticky, persistent, and broad-based feature of the economic landscape, the probability of a Federal Reserve interest rate cut in Q4 2025 significantly diminishes, assuming current inflation levels persist. The Fed's primary concern, as we've repeatedly emphasized, is price stability. Tariffs are inherently inflationary because they raise the cost of imported goods, pushing up consumer prices and potentially contributing to a broader inflationary environment. Jerome Powell and many Fed officials have explicitly stated they need more time to assess the full, durable impact of tariffs on inflation. If those impacts prove to be long-lasting and contribute to elevated inflation readings, the Fed will be highly reluctant to cut rates, even with political pressure. Cutting rates in such an environment would risk de-anchoring inflation expectations, which means consumers and businesses might start anticipating higher inflation permanently, leading to a dangerous wage price spiral. A rate cut would only become more probable if the labor market were to deteriorate significantly. For example, if unemployment were to rise sharply, or if other significant deflationary pressures were to emerge that could counteract the tariff-induced inflation. Absent those factors, a hawkish stance would likely prevail.
So it really boils down to how inflation behaves and the strength of the labor market. Last question. What are considered safe harbor sectors in a sustained tariff inflation regime?
Okay, safe harbors. In a sustained tariff inflation regime, safe harbor sectors would generally be those characterized by strong domestic production capabilities, a low reliance on imported inputs, or significant pricing power that allows them to effectively pass on increased costs to consumers without losing market share. Think about companies that produce essential goods or provide services locally, where their supply chain isn't heavily exposed to international trade disruptions or duties.
Can you give some specific examples?
Sure. More specifically, sectors to consider for resilience include: first, domestic manufacturing. Companies with U.S.-based production in areas like industrial goods, heavy machinery, or certain consumer products are less exposed to import duties and could even see increased demand if tariffs make imported alternatives less competitive. Second, utilities, which are generally regulated and have very low exposure to international trade, with costs often passed directly to consumers through approved rate increases, making them quite stable. Third, healthcare, especially domestically focused services and providers, would be less impacted by import costs, although, as we discussed, pharmaceuticals do have their own specific tariff disagreements. Fourth, commodities. If tariffs lead to higher raw material costs globally or create supply chain bottlenecks, commodity producers could actually benefit from increased prices for their locally sourced raw materials. And finally, logistics and infrastructure within the U.S., such as U.S. rail, port REITs, and domestic trucking companies. If supply chains increasingly shift inland or become more efficient within the United States due to tariffs encouraging domestic production, these companies would see increased activity and demand for their services, placing them in a relatively strong and defensible position.
What a deep dive. We've navigated the intricacies of President Trump's new 15% tariff baseline, examined how major global players like the EU, China, and Japan are reacting and adapting, and explored the sector-specific impacts on diverse companies from ASML to NVDA, Heineken, Audi, and LG. And all the while, the Federal Reserve stands firm, steadfast in its place, balancing political pressure against its core mandate, prioritizing inflation control over immediate rate cuts.
Look at the big picture. A key bullish theme emerging from this deep dive is the reduced trade uncertainty for critical sectors like semiconductors. This newfound clarity for many businesses could effectively unlock delayed investments and spur growth in crucial technology sectors that were previously hesitant due to the fog of tariff risks. However, the pervasive bearish theme remains the stickier inflation outlook driven directly by these higher tariffs. This means that imported goods will likely remain more expensive for the foreseeable future, which will probably keep the Federal Reserve in a hawkish holding pattern for longer than some might hope, as they rigorously battle to maintain price stability and anchor inflation expectations.
That's a perfect summary. A complex, mixed bag indeed, presenting both strategic opportunities and significant economic challenges ahead. Thank you for joining us on this deep dive into the global economic tug-of-war. Remember to follow the deep dive, rate the show, and join us for our next live cast. We look forward to having you with us again soon.